Hello, everybody. Before we begin, I want you all to just take a moment and read the subheading on the slides that is on your screens, or the Netra title slide, which is the title slide of our report. It reads "Early Signals Through Charts." I will repeat that: early signals through charts. So that is exactly what the idea is for this and every edition of Netra. To simply look at what the data is telling us today, the key word today, without extrapolating it 5 years into the future, and where this shift seems to be happening, and why that could deserve a little more attention going forward. And mind you, these signals that we're talking about, they could be warning signs or even opportunities going forward. So, with that, I will just try and give you a gist of what this presentation is all about. So, first, we talk about India's external situation and if the stress in oil prices that defined most of the past quarter even holds now. Second is India's growth and whether we are beginning to see signs of a turnaround. And if the answer is yes, we'll see where. And if the answer is no, we'll see how can we stimulate it. Next, we talk about whether the idea of diversification within the emerging market basket is being challenged. Next, we talk about de-dollarization. I think a theme that continues to stay in focus for a very long time now. And lastly, we conclude the presentation with talking about gold, a topic that the market doesn't seem to move on from. So, with that, I will invite Sahil to take over. So, just as a side note, during the course of the presentation, you guys can put in your questions in the question answers tab, and we will take them collectively towards the end. Over to you, Sahil.
Thank you, Pragati. Good evening to all of you. Thank you for joining in. So we'll talk about this July edition of DSP Netra and the key concepts which we are going to discuss. Pragati already mentioned all of them to you. So we'll start off first with some important observations from India's domestic growth and macros, and we'll make a case for what is a growth outlook and whether it is improving or not. So first we look at the balance of payment, and just about 30 days ago, or when June 2026 began, there was an expectation that in FY27 India will run a deficit on balance of payment of between 50 to 100 billion, depending on what your projections for crude oil were. And eventually, oil prices did not rise, and they fell in the last 30 days. Now they are more or less below the pre-Iran US war levels, about $68 to $70. So prices are back to where they were. And interestingly, one more development happened was that India allowed more FPI debt inflows, largely through participation and through changes in taxes. So what it has done is it has opened a new avenue of some amount of flow-in of dollar capital, and that we've seen that some numbers have changed. So maybe on 1st of January or 1st of June 2026, when you looked at the balance of payment, it would have looked very negative, largely because oil trade deficit was likely to be $220 billion based on the numbers back then. You can go back and read the earlier DSP Netra where we said that until oil crosses $120, we'll be more or less okay. Projections were that oil could go above 120 and eventually it did not. So oil trade deficit now, if oil prices average $75, will be around $123 billion and trade deficit will be 363 billion. This can easily be covered by India's software exports and remittances. So we are in a comfortable environment on balance of payment. Secondly, FPI flow, which has been a big issue. Last year, there were $16 billion negative, which was a big problem for balance of payment. As I've in previous DSP Netra highlighted that capital account has been the key problem area for India in the last 2 years. And that most likely now has improved quite a bit. So we've taken an inferior solution, which is, fixing up of the debt capital. In the short term, it might actually be a more superior solution because there is a lot of hot money which is going up and down in equity market. For debt market, specifically in the segment where India is getting money now, which is debt far, where the securities are of longer maturity. Usually, the capital comes for slightly longer duration, maybe between 2 to 3 years. So it could be more sticky. While we've seen that FI equity flows are much more volatile, right? So we in last about 30 days or so, calendar days, India's got about $6 billion plus in FPI debt segment, which is a good large number. And even equity outflows have reduced significantly. Now, these two numbers, along with expectation that we'll have between 30 to $50 billion in FCNR inflows, has changed the complexion of India's balance of payment. Now, why this number is important? One, when we run a very large deficit, okay, specifically, let's say we run a large current account deficit, it has to be covered by the capital account because eventually it is the balance of payment. So if we run a deficit because crude oil prices are high and we are importing a lot of oil, let's assume that we run a deficit of 100 billion, which was the expectation last year. Then we need to get capital in the form of FDI, FPI loans or FCNR or whatever way the capital comes in to cover this deficit. And therefore, we'll have a balance. If we don't get that capital, then we'll have a drawdown of FX reserves, right? And that is how the balance of payment can eventually balance by weakening of the currency, right? And in years when there is a balance, usually it happens that way. You don't have too much change in the FX reserve, or you might have actually a place where if capital count is very high, that means you're getting a lot of FPI, FDI flows. Your FX reserve might actually go up. In that case, if central bank chooses for that to happen. So in FY27, earlier it was expected that India will face a situation where current account will be highly negative and we are not getting enough capital, right? And that was a big problem. So to solve that problem, we had to take some measures if that problem were to come true. And those measures were what I've written here, stressful, right? Now we don't have to take those measures. And suddenly within the 30-day window, this balance of payment, which was a point of stress, has become a point of strength. So FY27 can actually turn out to be a year where we'll have a large cushion or a large, place where our FX reserves will come back, right? And this makes a big difference between, what macro were on 1st of June and what they are today, right? On 5th of July. So this is also reflected in how our FX reserves are moving. I've just put down two tables. This is not part of the original report. This is from the RBI website. When you look at the data for India's FX reserves, right? On 27th Feb, our FX reserves were about $728 billion, right? These numbers are in million. So about $728 billion. And as of the last reading on 26th June, our reserves were 666. Now, these are very low reserves, right? This is the cyclical low in this cycle. They haven't really gone up. As I said, that FPI debt flows have just cancelled out equity as outflow. They have not caused net inflows. Although last month we ended at, even Stevens. We did not have outflow or inflow in the month of June. When you look at debt and equity put together, equity still had outflows. But what is very, very notable in this data is if you look at it closely, the foreign currency reserves, which is made up of currencies like US dollar and others, they were 573 billion on 27th Feb and 541 billion as of 26th June, right? So about a drawdown of about $32 billion. But what is more notable is that we also lost 30 billion on gold reserves, right? Which is the MTM effect of the price moving down. So the impact on FX reserves is not only from the the foreign exchange reserves in terms of currency assets, but also from the gold reserves. And gold reserves are very, very price sensitive. Of course, they move up and down. So one very notable point is that the FX reserve situation has improved materially, although it might not look that way because they continue to be at series low. because foreign exchange reserves have made a comeback. And my sense is that as the number progress week on week, we'll see a lot more uptick in FX reserves based on FCNR inflows, which will happen, and based on the debt inflows which are happening. And if you see a point where FPI outflows stop from equity, then this number can significantly improve. Now, as I said that in just last few weeks and 30 days or so, we've shifted stance from the market narrative quite a bit. So a few weeks ago, the narrative was that India's share in the emerging market basket has dropped significantly, so we will not get inflows. We were the best performing market just 2 years ago. Now we've become the worst performing emerging market. We had the most stable balance of payment before this West Asia war took place. And just a few weeks back, we were earmarked as fragile one, right? And I remember distinctly that about 2 years ago, there were narratives that India will get about $100 billion in FI inflows. And now there are narratives that you should not be buying Indian equities, right? So these are the dichotomy of market, that some of these narratives are built exactly at the wrong time, right? If you look at this data on your screen, this orange line that you see is India's trade balance. It is at lifetime low, right? And the blue line is the FPI net flows 12-month sum, which means that over the last 12 months, FPIs have sold about $38 billion, right? Which is a very large number, right? This is a rolling sort of 1 year sum, one of the highest on records. Now, as you can see that both these lines are, fluctuating. They move up and down. There is a good likelihood that they also move up and down based on how valuations are panning out. So just about 2 years ago, we highlighted the same line saying that we've got a very large inflow. If you go back to FY 24-25, you will see large inflow from FIs. I think 1 year was 20 billion plus. Valuations are very high. And we were at very close to record highs in terms of how much inflows we were getting. And suddenly we are at close to record lows. And just like pendulums, I think these flows also move up and down. So there is a likelihood that these flows will make a comeback. And in the same vein, the orange line that you see, which is the trade balance, when you look at it from as a percentage of GDP, it has not deteriorated sharply. On an absolute number, this orange line has fallen and fallen. But as a percentage of GDP, which is a better representation, it hasn't gone down significantly. So that will also make an improvement, because oil prices, of course, are now making a comeback, right? So we believe that this is the time where rupee assets will make a lot of sense. We wrote a note on about 20th May 2026. Luckily or surprisingly, that day rupee was at 96.90. And since then, rupee has seen some amount of stability of about 2 rupees or so against the dollar. And what were the key driving factors? So rupee real effective exchange rate has fallen to an extreme level. You can see that rupee real is at about 88. I'm sorry. It was at about 88 or below 88 in the month of May. And we've seen such low levels only twice before in the 21st century. One was during the global financial crisis. The other was during 2013 twin balance sheet problem. And if you look at the year-on-year or 2-year rolling change, also has hit a very, very extreme reading. These are the readings from where rupee actually strengthens, doesn't weaken. Maybe strength is a very, very relative word, because it all depends on the central bank, whether it will allow rupee to appreciate or not. It can choose to build its FX reserves rather than choosing or letting the rupee to appreciate. And we think that FX reserve accretion could be a better strategy. Third is that there is a market narrative that rupee will continue to depreciate against the dollar, because India, US, inflation differential is 4%, right? And that is the narrative that we all hear on a consistent basis. But when you look at the data, you'll see that the relative differential between India and US inflation has actually declined. It is making lower lows, and in fact, from 2020 to today, the average inflation differential between India and US is now only 40 basis points now. And even the min and max ranges have shifted significantly lower. So earlier, our long period average were 4% or higher. Now the max that we've seen over the last 6 years is 4%, right? And minimum we saw was negative 2.8. In fact, in the last 12 months, India and US differential is 50 bips in favor of India, right? So which means that this long-term 4% depreciation that we've seen in the rupee will again depend that India's inflation and US inflation goes back to this 4% spread. Now, maybe it can go back, but as of now, it is not at that level. And rupee is already at a very weak level. And therefore, it makes a lot of sense to not go short on the rupee against the dollar and look at it more favorably, right? And nobody buys the currency, they buy currency assets. So it makes sense to buy rupee assets at this point in time rather than go away from it. And that is the whole thesis that we built earlier. And we continue to see that this is a very, very important change which is occurring. Next is that what kind of rupee assets could be favorable. So, of course, large cap stocks make a lot of sense. We'll talk about that in the next few slides. But here we are talking about the debt market. We think that maybe bond yields in India are too high. So eventually duration assets will make a lot of sense. In fact, when you look at the data over the last 30 days, India GSEC has seen one of the strongest rallies on record. It has fallen from 7.12, which was the war high for 10-year bond yield, and it has come down to below 6.7%. So we've seen almost 40 basis points plus rally in yields, which means real yields have fallen. But are the interest rates high, right? This is a question that the slides asks, and we have some data to look at. First is that India's real rates continue to be very, very high. When you subtract where our inflation is today from core CPI, you will see that our rates are too high. Between 2.5% or so of real interest rates are available in India. Historically, our spread has been about 100 basis points. RBI in the past has also highlighted that they want this spread to be at about 100 bips, right? So we have very high real rates, and real rates hinder economic activity. And second point is that what are the key drivers of interest rates? One, of course, is inflation. Second and more important driver is government borrowing. And the government borrowing program is stable. It's not very high or very low. It's very stable. There is no surprises or big negatives. One big negative was coming up on the horizon that if oil prices continue to remain high, maybe government will have to foot a very large bill, by providing for oil subsidy, etc. But that has not come to fruition. Right? Third is that inflation itself is at a 4-decade low. You can see from data, it hasn't really gone up. And even the drivers of inflation are very, very benign. India's core inflation, which is ex food and fuel, is at about 3.5%, which is very, very low. And we'll come to that also why that is a very important number. I've repeated it twice and thrice. Third is that because nominal GDP itself is below 9%, rates at 670 or 680 do not make sense. They continue to be too high, right? Which means that either economic activity has to slow down, or if authorities, which is the central bank and government of India, wants growth to make a sharp comeback, then they will have to bring down rates, right? Which is the job of the central bank, because the other drivers are well aligned, right? Fifth is that interest rates are sensitive to credit events. If there are a lot of bad assets in the economy, you will have an extra spread, which is the credit spread or borrowing by businesses, to be much higher than the GSEC yields, right? At this point in time, India has the lowest NPA seen in decades, And the balance sheet of corporate India is one of the best in about 4 decades, right? Which tells you that the NPA cycle also favors lower interest rates than higher rates. And last is that Indian consumers pay one of the highest nominal rates or even real rates across the emerging markets. In fact, when you compare some GSEC yields in India to other emerging markets, we are, much higher than many other emerging markets. So it makes a lot more sense for rates to be lower in India, whether they are manufactured by the central bank. If it doesn't manufacture, then probably growth disappoints and rates eventually fall themselves to stimulate growth. In both the scenarios, we think that it's quite possible that if we don't have an external shock like we had the war shock, etc., then rates are headed much lower, and that will continue to make GSEC one of the most attractive parts of the market. And we maintained this stance for the last few months. In fact, war became a good addition point because it did not, flare up to levels where it would have taken yields to a much higher point. Now, if you look at the arguments that we've done so far, what are we saying is that India was presented with an economic shock, or at least a shock in expectation or narrative that we can have a shock, although it did not materialize because oil prices fell and the war more or less has cooled down. And now what we are seeing is that our BOP, which was becoming a stress point, has now becoming a much stronger point. But we still have a problem that growth is not strong, right? And we need to solve for that. So currently, when you look at the core CPI, which we have taken as a proxy for demand, you can see it is running at multi-decade lows, right? So last 12-month average is just about 2.4%, very, very low in core CPI inflation. It is usually driven by demand. This is a part of the consumption basket or inflation basket, which is driven by consumption or demand, right? And capacity utilization level is also very, very stagnant at about 75%. Usually we've seen that capacity utilization's level falls as CPI cools down, but CPI did not have a very large uptick period either ways, right? So we are seeing capacity utilizations are also stuck at about 75% level. So this is a sort of a patch where a very strong or a purple patch for demand revival is possible. Why? And let me explain that. It's very, very important. When the economy has excess capacity, right now we can go to 80% capacity utilization or 85% capacity utilization because there is capacity in the economy, which means that we are in sort of a mid-cycle or in a revival, right? Where economic growth can go up or economic cycle can improve from where we are, which will cause our core inflation to also move up, right? To a more normalized level. Right now, core inflation is very low. So our inflation likely should go back to about 4 to 5%, which is what is needed. Okay, if that happens, then we will have a scenario for at least a few quarters where you will see demand will pick up and inflation will go up only to 4 to 5% and not go to catastrophic levels, which will allow RBI to continue to remain dovish or neutral, right? And not focus on raising rates because inflation is high. And that is the period where slowly and steadily capacity utilization can go back to 80, 85%, right? And that I think is probably this type of macro setup is probably a very, very good setup for equity markets, right? So I've written here that the most ideal zone or a purple patch is when the economy is in a recovery phase, which possibly we are right now. Fiscal situation isn't tight, which it is not right now. The central government is more or less sideways in its spending, and the central bank is benign, ensuring very high liquidity, right? And all these segments are present in the economy as of today, which makes it a very, very fertile ground for equity markets, right? So if you put it in one line, it is said that a middling economy and a benign central bank. Okay, this is one of the best setups for equity markets, and we are sort of there, right, at this point in time. Maybe we'll get there in the next 1 or 2 quarters, but conditions are becoming going in that direction. So if you are following the line of thought, as I said, if this happens, then probably we'll see inflation move up a bit from very low levels to more normal level, and that will also cause our nominal growth to improve. Okay, India's nominal growth has been low, and we've highlighted it multiple times over the last few years that nominal growth is what helps corporate India do better, right? And why are we saying that? Look at this data. So this data, slices corporate India, listed India's revenue growth and profit growth, right? So if you look at these periods from FY04 to FY08, we had like a double powered cycle where our revenue growth was 26%, PAT growth was 29%. A remarkable achievement. We haven't repeated that ever again. And we had other periods also where revenue growth was high. We also had good PAT growth. Now, in this cycle, we have a very different cycle where our revenue growth or sales growth has been very, very low, about 8 to 9%, right? If you remove some of the oil marketing companies, etc., this number goes to 8% or lower, right? And this is something which has been a troubling factor. Why? Because there are only two things which can improve profitability. One, if you sell more, which is sales growth, whether it happens by volume or price. Second is PAT margins, right? Either you sell the same thing with a higher margin, your profitability will improve, or you sell more things, or you sell same things at a higher price, right? So either your sales has to go up or your profit margins have to improve. Now, what is important is that in this cycle, profit margins are already at close to lifetime high, right? So there is very little chance that we are going to improve on margins. Maybe we can just hold on to these margins or these margins will decline. And this is the same argument that we showed in FY24, that this is the time where our revenue growth is declining, margins have already hit the peak, and therefore PAT growth is unlikely to surprise on the upside, right? Now we have come on the other side where revenue growth has slowed down, and we have seen some signs that revenue growth, which is dependent on the nominal GDP growth rate, can make a comeback. And over the next maybe 2 quarters, 6 quarters, 8 quarters, we'll see some uptick in revenue growth because nominal GDP growth will make a comeback. And this will allow profitability to improve from where it is right now, right? And don't go by these numbers of just 5% and 15% in terms of FY25 and FY26, because the complexion is very, very different, right? So when you look at these numbers, for example, there is an expectation that mid and small caps have shown very strong earning growth. Now, this is the common narrative as of today. But if you look at FY25 to FY26 and look at it, these 2 years in the block, their earning growth is same as large cap. There is no difference. And if you look at it from FY24 peak in terms of prices, difference between performance of small cap and large cap is a measly 5%, right? Which is nothing less than randomness, right? So you don't take any decisions based on what stocks have done over the last 6 months or 3 months. In fact, at the end of March 30th, small caps and mid caps are underperforming large caps from the peak by a very wide margin, right? And these 3 months, 6 months movements are more or less randomness. The key point is that if revenue growth comes back, there is a likelihood that stocks will perform. Now we want to see which stocks will perform, right? First is that the large caps are significantly under-owned today, right? Their share in the overall market cap is only 17%. We made this slide first time when this number had hit 19%, if you remember. That was the lowest low. We had some improvement. Now we are back to even worse levels than they were there. So we've lost another 200 basis points on market cap. Now you could argue that this series is headed to 10%. If you drop some numbers and do some mathematics, the likelihood of that happening is very, very low. And the likelihood that this ratio improves is very, very high. The only thing is that we don't know what that exact number of turning is, right? But one thing is clear that the share of large caps is set to improve significantly over the next few years. We just don't know when it will start, right? Second is that FI ownership, which has been hit significantly in India, has seen most of its losses in this segment only. In fact, 2/3 of all FI flows come to the top 10 stocks only, right? Which tells you that there is a very large share of FI selling which has happened in these stocks, right? And that is also a reason why in the short term this market cap recalibration has happened, right? When you look at the valuations for the top 10 stocks, all of them are now trading below their 10-year average multiple. Some of them are trading at their lifetime low valuation multiples, while their return on equity continues to be very, very high. This data was true 3 months ago, even 6 months ago. Valuation data was not exactly the same 6 months ago. It has become even more better today with all the selling that we've seen, plus the earnings uptick that we've seen, which means that this universe continues to be the most attractive part of the market. In fact, if you have a new rupee allocation, the first port of call should be the large caps. And not just, let's say, the top 10 stocks, but from top 1 to 50 or even 100, there are a lot more opportunities than there were earlier. Second is that private banks. Now, private banks has something special which you can name as triple dip. What is that? They have got low valuations, where valuations are for some stocks are at lifetime low. Their profitability continues to be strong. Earning growth is also strong. Most banks are reporting between 12 to 20% earnings, give or take, whatever you want to look at. The variation is high, but the numbers are strong, and they have very, very good asset quality. So NPS are at historical low. So you've got a wonderful combination of good valuations, good earning growth, and quality of the business being maintained in terms of NPS. This is a rare combination. The only thing is that you will have a lot of questions because prices have not done well, right? Stock prices have come down, and usually markets are, a slave of stock price. If they don't move, the narratives are not built. But we think that this is the right time. This is one of the better opportunities to look at, where you've got all grounds covered, and they very rarely come, right? These kind of opportunities rarely come, and we think that private banks present one such opportunity. Second is cement, which is again presenting a very important opportunity, where cement production has started to improve in sort of a secular manner, a very good trend. Second, we are seeing a very, very important change where input costs have started to fall. Although in this quarter, input costs will show an uptick when the results come out because of the war. But overall, their descent has started. If you look at the hard numbers of input from a week-on-week basis, and which means that operating profit margins, which were at cyclical low for these companies, are going to improve, right? Another very, very important factor of cement is that it is a best proxy for the construction and infra activity, right? Well, many companies in the industrial construction infra sector are trading at very high multiples, right? But this is a proxy for that a sector. And if you look at the government expenditure trends, you will note that government expenditure significantly improves when it comes to second half of the term, right? And it usually declines in the first 2 to 3 years. And now we are entering the second half of the central government's third term. It's a good likelihood that you will see an uptick in expenditure activity, and that augurs well for construction itself. And cement, we think, is one of the cleanest places where this operating profit margin improvement can improve profitability significantly and improve valuations also. Some of the bottoms up pick in this segment see straight away improvement in profitability as their top line improves. The next is on Nifty IT. So these are the sectors that we are enumerating where valuations have improved and we see opportunity. IT is a unique segment where there are two schools of thought. One which looks at valuations. So this is the slide which gives you the current valuations for all the IT constituent companies. You can see the top 4 large IT companies are now trading below 15 times multiple. In fact, the top 3 are trading below 14 times the PE multiples. Their 10-year averages are very high. In fact, the pre-COVID averages are also about 18 to 19. So they're below that number also. FCF yield for top 4 companies is close to 7%. They extinguish equity by about 90 bips a year. So effectively, this is a sector which, at this point in time, if you do not see a D rating in multiple, right, which is debatable, will get you close to fixed income returns, right? Just based on the FCF yield that they are giving. And of course, the shareholder yields is also very high, about 5.7 to 6%. Imagine we're talking about tech companies giving you shareholder yield, which is dividend yield plus buyback, right? Nobody would have spoken about it earlier, but this is where we are at this point in time. So one is that valuations for this sector has come down significantly. But what are the risks? So risk is, we've enumerated about 4 risks here. First of all, and which is one of the biggest one, is that there is a large and steady improvement in India's software exports. So when you look at the software exports of the country, they continue to show a very strong CAGR growth rate. Now, if software exports are improving, then of course listed universe should also see top line improvement, but that is not happening. So there is a very important distinction that GCCs continue to take away market share from listed companies. And that is the reason why software exports are improving, but top line growth for Indian IT companies are restricted. So this is one of the key headwinds for IT companies. Second is an expected headwind, which comes from AI, which is still in the narrative, not in numbers. Maybe it will come in numbers. We don't have a proof as of today. Some reports say that about 40% of the revenues of IT company will see deflation of between 3 to 5%. And the rest of the book can see improvement to stagnancy, leading to just about 0 to 3% revenue growth, right? And that is the impact that the market is placing in, that these companies will not show any revenue growth at all, right? And therefore, why to pay any multiple which is higher than maybe 10, 15 times or 10, 12 times for these companies? So this is the base case which has happened in terms of narratives today. And the next one is that a number of global IT companies are trading at lower valuations than Indian IT companies. Now, this is a feature which has always happened. This is not the first time. The differential has always happened, but at the bottom of the cycle in terms of valuation, this question is very logical, that why not to buy companies which are of same quality or better quality and available at cheaper multiples, right? But you can make the same arguments for consumer companies and other companies. But there is no standard or logical answer to give to this. But this is a very, very genuine relative comparison. And the last one is that there is a, let's say, litmus test or very important distinction, that IT companies' growth will come back. And a true reflection will be when headcount for these companies start to go up. Now, if you look at the data from FY 11 up until FY21, right? These companies had a headcount CAGR of between 4 to 8%. All of these companies, they were hiring a lot of people, and their revenue growth is directly linked to the people they hire, or their bench strength, or the number of employees, total employee headcount. And you can see since the advent of Chat GPT, which is what we are picking up in numbers, this is also a narrative that I'm building. So take it with a huge, truckload of salt, because this is how the dates are aligning. We don't know the exact cause, but from FY22 onwards, their hiring has more or less not grown at all. Right? And this is probably a signal which tells you that the companies themselves are not very confident of growth, right? And if this number begins to go up, there is a good possibility that their revenue improvement will also come back. Now, if you look at in totality, we need to answer these questions. Are these concerns priced in or not? And therefore, these valuations are attractive, or these concerns have just started, and therefore these valuations are not yet attractive. That answer you will have to give from an asset allocation point of view. But one thing is very clear, that valuations have significantly come down. About 3 to 5 years ago, when they were trading at 40, 45 times multiples, many of these concerns were still present, right? For example, GCC is taking away market share. Maybe the AI narrative was not that strong, but valuations were also very, very high. Now that valuation premium has completely gone away, right? So you need to think very carefully before acting in this universe or ignoring it. The next is El Nino, where we'll just spend a very short time. That currently the case that El Nino will cause significant uptick in inflation or downtick in growth, the data doesn't support that. And the reason is that A, India's irrigation cover has significantly improved. And secondly, that there are many factors which come into play when it comes to impact on inflation and on growth. It is not only about rainfall activity. There are many other factors which come and play a role. This table, if you read it carefully, will show you that there are many years where there is very strong El Nino, deficit rainfall, but still nothing happens to inflation or growth, right? And because there are many other factors which come into play. In fact, in ancient times, kings and rulers and governments used to utilize years of deficit rainfall to increase economic activity because they used to store food grains in the years of abundance and ask workers to work more and take the food grains, and therefore economic activity used to improve. And this story tells you that the government needs to spend more in those years and they can become actually fertile years for growth. Now, that is for a later date to talk about from an ancient perspective. One important distinction is that just El Nino may not derail or significantly cause any damage to growth or inflation expectation. It's a mix of many factors. So this is the first section that we want to talk about India macro. One very small section that we put on emerging market. So emerging market rally has seen significant, legs, largely driven by two countries, which is Taiwan and South Korea, where multiples have expanded significantly. On trailing PE multiple, their multiples have gone through the roof. They trade at a very high, steep premium to their historical multiple. Of course, their forward multiples are very low because markets are expecting 50 to 70% growth in the EPS of the index, right? Which is unthinkable in terms of index. And the reason why that is happening, because they're dominated by just a few companies, right? So they are very, very concentrated. Now, this also unmasks a narrative fallacy that we see in the market. So a lot of people believe that concentration is not a good thing. And there is a lot of same money chasing these trends today. So a lot of people want to put money in, let's say, a passive index in Taiwan or in South Korea, thereby getting exposure to just three companies, right? Which is equivalent to being one of the most concentrated. And here we've shown that how concentration risk has gone up in the emerging market. Korea and Taiwan now account for more, just about 50% of the MSCI emerging market basket, which has never happened earlier for these two countries. And there was a point where, China plus India weight would have been around 50% or so, or maybe just south of 50%. But these two countries are much bigger in size. Their economic activity is also much larger in size, and the underlying stock basket is also very, very diversified. But this is the first time when you've got these, significant extremities in place. Very, very high performance and very, very high share. Both are an offset of each other. Now, what it has done is it has created a very, very loop-sided sort of a index. Why? When you look at the MSCI emerging market YTD return, it is about 25%. 25.6, which is more than the index return, has come just from technology, right? Which means that all other sectors have actually fallen within the MSCI basket. Only one sector has done a positive return this year. Out of this 25% return, 18% itself has come just from three stocks. Now, this is the kind of concentration we are talking about. This concentration beats even the NYSE FANG rally that we've seen over the last 5 to 6 years. That rally pales in comparison to what has happened to this basket, and it has made it very, very concentrated. And if you look at the past, these kind of concentrations don't end well. Therefore, it makes India a much better place within the emerging market basket to play this mean reversion. If you go back to October 2024 and search for DSP Netra, you will see a chart where we showed that India's performance is so out of whack versus the emerging market that we are facing very steep odds of a mean reversion, where India will not do well, emerging markets will do very well. You can go back and see that slide. It's there. It has two lines where India's performance is going up and emerging market performance is going down. We are exactly at the opposite end today, and therefore it makes India a much better place. But once again, as I said earlier, within India, the whole market is not cheap. The cheapness is present only in some pockets, and that is where we need to be focused on. The next is a section on US dollar, and we've spoken about this earlier. I will explain this in a very brief segment. US dollar, de-dollarization and the demise of dollar has been a dominant theme for some quarters and maybe 2 or 3 years. Why it has happened? Because post-COVID, US took a lot of debt and significantly levered up. And a lot of people said that it will become very difficult for US to service its debt. Even in DSP Netra, you will see that we have published this data that US debt servicing has gone up significantly to 3.5% of GDP. And therefore, it can cause some uptick in yields. But this whole idea of de-dollarization appears to be on shaky legs. Okay, why? I will explain that to you. In any economy, there are three economic agents. One is the government, the other is the household, and the third is the private sector or the corporates or the companies. When you look at the US debt situation, the total US debt of all these three entities put together is now lower than it was during global financial crisis, or is exactly the same. It has actually fallen since COVID. It has not gone up. Although the narrative is that US debt situation has deteriorated. But when you look at all the three economic agents, the situation has actually improved, right? How did that happen? So if you look at over the last 15 to 17 years, US government has taken a lot of debt, the sovereign government and the local government. But the private sector and the household sector has delevered. So the household sector, which was running at 96% of GDP in terms of debt, has come down to 68, while the private sector has more or less remained close to 45%. So there is no change in the balance sheet of corporate US or US Inc., while household has delevered significantly. In fact, US corporate balance sheets are one of the strongest and household balance sheets are one of the strongest. The only change which has happened is that sovereign US or the federal government has taken a lot of debt. And that single factor has led people to write about the demise of the dollar because US sovereign has become significantly high. And one overarching theme has been that the world doesn't want the dollar anymore, and therefore nobody's buying dollar assets. And here we present a data where it is true that sovereign demand for US dollar, which means US Treasury, has gone sideways. It has not improved at all. But look at the demand from private institutions, which is pension funds, hedge funds, investors. It has gone through the roof. It continues to scale at a very fast pace. And here we are only talking about US bonds. We are not even talking about US stocks or real estate. If you put all that data together, over the last 5 years, the demand for, if demand for any currency asset has improved, it is for the US dollar. It has been one of the fastest growing asset in the whole world. And at the same time, we are talking about de-dollarization. So they don't gel together at all, and which tells you that the dollar is here to stay. And we wrote about this whole section in November 2025. You can go back and read. This is an update on the same sector. Since then, the dollar has been stable. Although the call was for a large depreciation of the dollar, in fact, there were calls for devaluation of the dollar, but nothing of that sort has happened. In fact, it has inched up since then, not moved significantly, but maybe inched up a little bit. Now, which means that to conclude that section, we think that the dollar is continue to be here. It can depreciate or appreciate by maybe 5% here or there. It's very clear, but this demand for the demise of the dollar seems overdone and overblown. and therefore that should not be the premise for making any investment decisions. The last section is on gold and silver, and this is a section where a lot of queries have come significantly. So first we'll look at our framework on how to value gold and silver. One notable point is that both gold and silver have fallen below their theoretical price assumption that we make. How do we make these assumptions? I've written a slide on how these assumptions are arrived at. Put simply, what we do is that we take the current value of total mined gold, which is about 7.24 billion troy ounce, divide this number. We use this as a divisor to look at what is the total money supply in the world. The starting point is an assumption that gold is money. So if gold is money, then the total stock of money in the world is the value of gold today. And how do we arrive at that? We look at US money supply and we look at 50% of EU money supply. Now, why do we do that? We've written the whole thesis here. You can go back and read about it. The main point is that currently gold and silver are trading at a discount to the fair value that our model suggests. Now, this model is a theoretical exercise that we have done. It may be right or wrong. You can assess it on its merit, which are written in the next slide. But one point is that if you think this model is wrong, make your own model. That is the most important point. You need to have a framework to value these assets. It can be good or bad. It can give you a fuzzy number, but it will help you make better decisions, right? Now, we've put down some questions, some discomforting question for gold bears, right? What are the discomforting questions? If US fiscal deficit is going to be high, and there are going to be widespread wars that we've seen over the last, 6 years or so, and central banks are going to continue to buy gold, which they are still doing. Why gold prices should decline significantly, although they have already done about 30% correction or so. But do these questions tell you that the underlying trend for gold prices to go up is continue to be positive, right? You need to, question any negative long-term ramifications for gold based on these questions. Now, we don't have a clear answer for this. Why we put down here is that these are some of the important questions which will, make us understand that what are the argument against being negative on gold, right? Why should you be more positive about gold? And then the next slide, we look at some arguments which make the bulls uncomfortable. What are these arguments? That this bull market was dependent on central bank buying, and central bank buying has become sideways. And if you go back to our previous discussions, we spoke this aspect that 1,000-ton buying by central banks at 2,000 gold price is not equivalent to 1,000-ton purchase at 4,000, right? It makes a big difference, and that difference has happened in the price. The prices have come down. Second is that ETF and other instruments are pure momentum chasers. They come at the wrong time. This is the chart that we made back in January also. And you can see that the demand from these instruments have started to fall significantly just because prices took a correction, right? And third is the jewelry demand. Now, these three are the biggest driver of prices: central banks, investment demand, and jewelry. If all the three are absent or sideways, then who will cause the prices to go up? Because eventually gold is just a commodity. So now you need to answer these questions to take your own assessment on what will happen to the prices. This is our assessment. Now, next two slides is when we look at the data, what we make of it. First is that if you go back to Jan, gold prices were beating yielding asset, which is stocks and bonds, by a very wide margin. If you look at gold returns were 41% CAGR in this cycle, right? From September 22 to Jan 26, they were about 41% CAGR, while stocks were at 20% CAGR, which itself was phenomenal, right? Since then, the CAGR number has gone down, but it has not gone down significantly. It continues to be very high. Even 5-year CAGR is beating stocks and bonds. Even 10-year CAGR is at 12% or so, which is sort of a bull market high for gold, right? It's not a small number. So we think that this is still not the time to be overweight. Maybe the prices needs further correction or a time correction, right? Either prices fall more or there is a time correction. And then we wrote what should be the framework to think about gold and silver, which I will just enumerate. One important data observation that gold and silver peaked in January 26. We are just in 5 to 6 months away from that peak. Historically, they've taken sometimes years to go back to their previous lifetime high, right? So maybe this is still too early to become too positive on gold and silver. Maybe it is not, because history is just a guiding light. It's not definitive, but it certainly makes a case that if their CAGR returns versus yielding assets is still very high, and history also doesn't support a very quick return to lifetime high. So maybe it's a possibility that precious metal will spend more time, or they need more price correction to become more attractive. Now we've written a 5-step framework on how to think about allocating to gold and silver. First is that they should have a large discount to their theoretical price. So the framework that I showed you earlier in the first slide of this section, and what is a large discount? Now it can vary from investor to investor, but we think at least 20 to 25% discount is logical. When we first became positive on gold and silver back in 22, they were trading at a 50% discount to theoretical price. Now you can think about how loop-sided that was. So that kind of a discount will of course give you a huge amount of confidence. Currently, we are not there yet. For gold, we are just at about 10% or so. Second is at least 3 of the large drivers, whether jewelry demand, central bank, or ETFs, they should turn big incremental buyer. What is big incremental buyer? That means their demand this year should be higher than the last year. What is higher? At least a ballpark number of 10% or more. Okay. And these numbers are not a figment of our imagination. They are very, very important percentage changes, because the demand and supply for gold doesn't move more than 1 or 2%. So if a big number, for example, jewelry demand, which is more than 35% of the overall number, improves by 10%, it can move the overall demand by 2 or 3%, which can create a supply demand imbalance, right? And therefore, this number of 10% is a thumb rule, but a very, very important thumb rule. Third is a probability of fiat or a depreciation bias for DXY index, which means that there is some concerns on currencies or depreciation bias for the dollar, which at this point is missing. Point number 1 is missing, point number 2 is missing, point number 3 is missing. Specifically for silver, we need a gold and silver ratio, which is at least 80 or 85%, 80 or 85 or higher gold silver ratio. At this point in time, it is close to 68 to 70, not good enough. And fifth is that the overweight stance on precious metal should be exercised only when you see rapid selling in these markets, right? And largely when ETF selling is very, very high, that creates a lot of opportunities, because you see rapid price decline, that gives you great entry points, which at this point happened somewhat, but they still continue to be very, very overweight when you look at the tonnage situation of ETFs. So maybe we are not there yet in terms of prices. Maybe we'll get there. But certainly one thing is clear, that the froth that we saw between Jan, Feb and March of 2026 is no longer there in the price. So maybe this is the time to be more neutral about them, maybe have small weights, but maybe a time to become overweight on these metals will come, as we go ahead. So this was the, section on gold and silver. And I think here, this is just a behavioral slide, which of course you can go back and refer to. This was a long discussion today, so I will stop here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.